Hey everyone, welcome to today's deep dive.
Yeah.
So, our mission today is to unpack this incredibly volatile 24-hour cycle we've just seen in the market between, May 19th and 20th of 2026.
Yeah, and it's a fascinating setup because, well, we're seeing this massive divergence, right? I mean, immediate price action is just bleeding out.
Oh, absolutely. But underneath that, the underlying institutional architecture is undergoing what looks like a historic, permanent upgrade. And just to be clear for you listening, we are looking strictly at raw market data, executive orders, and corporate treasury metrics from the past 24 hours.
Right. No basic definitions today.
Exactly. We're diving straight into the deep end.
And to really understand the bleeding, you have to look at the macro gravity. So Moody's just downgraded the U.S. sovereign credit rating to AA1.
Which is huge.
Yeah, it sent the 30-year treasury yield surging to 5.198%. I mean, we haven't seen levels like that since 2007.
Wow. And you have to think of that 5% yield like basically a giant industrial vacuum cleaner.
That's a really good way to put it.
Because when risk-free debt pays over 5%, it creates this mechanical vacuum that just sucks excess liquidity straight out of high beta assets. Yeah. It doesn't even matter how strong the underlying network is. Quantitative models just mechanically siphon that capital away.
Right. They blindly pull it out. And we saw that vacuum in action with a nearly $2 billion outflow from U.S. spot ETFs over just 7 days.
$2 billion. That is brutal.
Yeah. It temporarily trapped price action right below that critical 77,500 resistance. But, inflation dictates those yields, so energy prices are kind of the only thing that can shut that vacuum off.
Well, and we did get some wild geopolitical shifts there. Iran proposed reopening the Strait of Hormuz for sanctions relief, and President Trump formally paused his planned kinetic strikes.
Exactly. So the energy pressure might cool down.
But wait, let me challenge you on this. If the macro environment is so hostile right now, with the 5% risk-free hurdle rate,
right,
why are Tier 1 corporate treasuries deliberately stepping on the gas instead of hedging?
Oh, they're completely ignoring the macroeconomic panic.
Right. Like, Strategy just retired $1.5 billion of their own convertible debt. And TD Cowen raised their stock target to 400. Why?
Because they're taking advantage of the panic. They retired that debt at an 8% discount. That improves their balance sheet to fund even more accumulation. They aren't worried about the short-term macro noise because they see the permanent legislative shift happening behind the scenes.
Ah, right, the executive orders.
Yeah, 2 massive statutory directives signed in this exact same 24-hour window. The first one basically forces the Fed to evaluate grunting crypto firms' direct master account access to the Fedwire network.
And within 90 days, right?
Yes, 90 days.
Which in government time is practically light speed.
Yeah.
I mean, historically, commercial banks use that monopoly over master accounts to freeze these entities out.
Exactly. They force them to beg traditional banks to act as middlemen. This bypasses them entirely.
And the second order formally ends Operation Choke Point 2.0.
Right.
It legally codifies alternative assets in tax-advantaged 401k accounts.
Wow. So when you put those 2 directives together, it legally dismantles the legacy commercial banking monopoly over the industry.
It really does. It transitions the network into the absolute bedrock of the modernized global economy.
It's massive.
So for you navigating this environment, it requires extreme tactical discipline right now. Because, execution algorithms are out there hunting the $3.4 billion in long leverage, resting at 74,700.
Oh, yeah. The short-term microstructure is incredibly heavy.
But if you zoom out, the foundational utility of the network has basically achieved permanent institutional validation, which leaves us with a final puzzle to think about.
Let's hear it.
Well, Ledden projects a $1 trillion Bitcoin-backed loan market simply because people refuse to sell their collateral.
It's a complete paradigm shift.
It really is. So what happens to traditional fractional reserve banking when a massive portion of global credit is built entirely on mathematically verified, unrehypothecated collateral? Something for you to mull over as we watch this new engine get built.